Welcome to Crypto Law with Anne-Sophie Kloets. Welcome, Peter. Thank you so much for joining us today to talk about the EU's crypto legal framework. I know you have a long track record at the European Commission. Just quickly, what is your current role as an advisor at the European Commission? What is your involvement in the crypto legal negotiations of various crypto projects that the EU is working on? And how did you end up there?
Well, indeed, my official title is Advisor for Technological Innovation and Cybersecurity in the European Commission's Financial Services Department. And so this title creates the impression that I've got something to advise on, which is, I'm working on that. But sort of joking apart, in my current role, I have led the European Commission's Finance Department's work on digital innovation. That led to the Financial Technology Action Plan and the Digital Finance Action Plan, of which our crypto policies are a part. I ended up in this role after a rather long-standing experience in the Commission. I joined the European Commission in 1996, and I've been in various departments dealing primarily with what I would call single market regulation and policy, financial services, and so on. I was desk officer on a number of issues. I dealt with international and institutional relations, so relations with the Council and the European Parliament. I was in the private offices of two commissioners. I was the EU's finance counselor in the delegation in Washington, D.C. And from there, returning to Europe about 8-9 years ago, I was very struck by the very pervasive influence the newer generations of technology and innovation were having on the financial ecosystem. And drawing my authority's attention to this, they said, well, if you see there is a development, you think there really is a development in this that is going to be determining for the future of finance, why don't you take it on? And they made me advisor on technological innovation and cybersecurity. And that's how I ended up in this role. So I took an interest in it. I thought that digitalization and innovation would become a driving theme for financial services policy. And I think that looking back on this now, although we're still in this wave, I think that was a good call. And that's how I ended up in this job.
Definitely a good call. I think the job you have is a really, really interesting one. And you've also been very involved in the various crypto topics that the EU is working on, thinking about legislating, assessing, perhaps just trying to find out what to do with that. What are the various legal initiatives or other initiatives at the EU right now that somehow touch on crypto that you are working on?
There are quite a few. I'm working on either directly or indirectly. And I must say that crypto is just one of the financial technology areas we're working on. We also do work on cloud, on authentication technology, on digital identities, on high performance computing, on data portability. So there's a number of areas we work on. But it's fair to say that among all of these areas, crypto and distributed ledger technology get an awful lot of attention. And I think this is due to the fact that crypto and distributed ledger technology have truly transformative potential. Now, the various initiatives I'm involved in, or we're involved in, I would distinguish between, on the one hand, the use of distributed ledger technology and crypto in traditional finance, in traditional financial services, be it banking as such, or financial instruments in funds management. And there, really, it's what we're involved in is a clarification of the rules and basically an assertion or an affirmation that it is not because a financial instrument, a security, a debt instrument is in crypto form that it's no longer a debt instrument or it's no longer a security. And therefore, the form doesn't really matter for these instruments. What matters is their economic function and so the existing rules apply to them. So, for example, for those listeners who are familiar with EU regulation on financial markets, so the Markets in Financial Instruments Directive and regulation, for example, applies also to financial instruments in crypto form. But that being said, we saw that there are quite a lot of activities in the crypto space that have features of financial instruments that look a bit like financial instruments, but that are, legally speaking, do not qualify as financial instruments. Actually, the majority of crypto assets on the market, and certainly the largest crypto assets both in terms of market capitalization, but also in terms of daily transaction volumes, do not qualify under European definitions of either funds or financial instruments or banking products. And this may be different, for example, in the United States, where they take a broader definition of what is a financial instrument or a security. So we have a lot of the activity, crypto activity, that is not covered by existing regulation. And this presents a problem, both in terms of legal certainty and seizing the opportunities of crypto assets, but also in terms of addressing financial risks, market integrity risks, investor and consumer protection risks. And this led to the development of the main piece of crypto legislation which we have, which is the recently agreed Markets in Crypto Assets Regulation. So that covers crypto assets, the financial services aspects, or it's a type of financial services regulation for crypto assets that do not qualify as financial instruments. And so MiCA regulates or addresses the issuance or the placing on the market of such crypto assets, but also the provision of crypto asset services, brokerage services, exchange services, custody services, advisory services. That is covered by MiCA. And so entities that are licensed or authorized to provide these services will get what we call in the European context a single passport. So their license from one member state will allow them to conduct business without further hindrance in all of the member states of the European Union. These are the core parts of our crypto policy. But in addition to that, our crypto policy also covers cybersecurity. We recently agreed another very important financial services act called DORA, the Digital Operational Resilience Act, which is a regulation about cybersecurity in the financial sector. And this explicitly applies also to the entities that are covered by MiCA. So if you are an issuer of crypto assets, if you're a crypto asset service provider, you must also comply with the Digital Operational Resilience Act. Apart from that, we also are working on anti-money laundering legislation. A lot of people associate, I must say wrongly, but they do associate crypto assets with money laundering. Yes, crypto assets are used for illicit purposes, including money laundering. But the data, if you scratch a bit at the surface of the data, you see that actually most of the crypto transactions aren't at all related to illicit activity or money laundering. They are mostly related to speculative activity and speculative trading mainly. But there is money laundering activity taking place, and the European Union is quite strict about applying the international standards on money laundering or against money laundering, the Financial Action Task Force standards. And so we did that, or we're doing that also for crypto assets. So already the 5th Anti-Money Laundering Directive already covered crypto assets to a certain extent. It covered the fiat to crypto exchanges, so the on and off ramps, if you wish, for the crypto ecosystem. And it covered custodial wallet providers. But in the latest iteration of anti-money laundering rules, so the anti-money laundering regulation, we are extending the reach of anti-money laundering rules to all crypto asset service providers. So they will all have to become what we call obliged entities under the AMLR regulation. Then, I'm sorry to be so long because there's a lot of
There's a lot
activities.
going on.
There is the transfer of funds regulation, which is a very specific piece of legislation also in the anti-money laundering field. The transfer of funds regulation really is a regulation about information accompanying the transfer of funds. And it is, to be a bit technical, the implementation of recommendation 16 of the Financial Action Task Force. And recommendation 16 of the Financial Action Task Force deals with wire transfers and the information that must be added to wire transfers. The Financial Action Task Force extended this wire transfer recommendation to transfers with crypto assets. Now, this is a very debatable issue because crypto asset transfers sometimes are comparable to wire transfers, but often they are not at all comparable to wire transfers. But in its wisdom, the Financial Action Task Force included a recommendation on crypto asset transfers into this recommendation 16. And so the EU is implementing this in an update of its transfer of funds regulation. So traditionally, the transfer of funds regulation dealt with payment transfers, or wire transfers, to use the American term. And now it will also apply to transfers of crypto assets if there is an intermediary involved. And that's very important because the FATF framework, the Financial Action Task Force framework, and our anti-money laundering framework in general is a framework that is implemented through intermediaries. It is not the users, the consumers, if you wish, or the recipients of a transaction that have to meet the obligations of our anti-money laundering regulation, but it's the intermediaries, the banks, the fund managers, or in crypto space, the crypto asset service providers. They have to meet these obligations on knowing your customer for general money laundering regulation, or making sure that any transfers they initiate or transfers they receive have the necessary information about the sender and recipient of the payment. And then there are two final pieces we're involved in. Me personally, to a lesser extent, in the area of taxation. So, of course, as the crypto ecosystem grows and is relatively successful, even in times of crypto winter, there's a lot of transactions going on. This, of course, always triggers the interest of tax authorities and whether or not this activity is taxable. Now, that issue in itself is not necessarily addressed at the EU level because of the unanimity requirement for taxation at EU level. But the EU does have a lot of regulations or frameworks for the information exchange between tax authorities. And so our work on crypto assets is, our crypto assets related work focuses on whether or not intermediaries in the crypto asset field should report transactions and activities to the tax authorities, so that their customers will meet their tax obligations, whatever these tax obligations may be. And then finally, and I put this really at the end, is we're also working on a digital euro. And I put this at the end because it is not necessarily the case that the digital euro will be a crypto euro, will be a distributed ledger based euro, because the technology choice for a potential digital euro hasn't been made yet. But the European Commission is working on a legal framework for a digital euro, to empower or enable or support the European Central Bank in its decision to issue a digital euro or not. So whether or not there will be a digital euro is ultimately a matter for the European Central Bank to decide. But we are working on a framework that would clarify and empower the ECB to do so if they see fit. So this is, I would say in a nutshell, but it's more than a nutshell, all of the crypto related activity I'm involved in.
That's a lot. You definitely
And
have a
that was
very
just at, sorry, go ahead.
so then that means you probably have a very good overview of how it all those different rules like tax, digital euro, the transfer fund regulation, all these things work together, and whether the rules actually make sense as a unified approach to regulating crypto as such, not just an AML part or a tax part, how they all work together. But sorry, I interrupted you.
Well, I try to keep that overview. Sometimes I lose also a bit of track because indeed there are many moving elements, and that was just at the EU level. We also have a number
Exactly.
of national developments, and we also have a number of international developments, both at the FSB, the G7, which I'm also involved in, bilaterally with the United States, with some of our Asian partners, the United Kingdom now, of course, no longer, unfortunately, a member state with Switzerland. So all of these activities all kind of influence each other. And I'm doing my best to keep track of everything.
Not easy. There's so much going on. And then the industry itself obviously also changes so quickly. Perhaps one question at the EU level. You are part of the European Commission. Then there's the member states who have their own opinion about crypto. Then there's a parliament, the European Parliament, where individual parliamentary members may have their own views about crypto. What do you think are the main concerns that you see with your colleagues at the Commission? Are those concerns any different than what you see at the European Parliament level or the government level? Are the benefits that each one of these three slightly different groups may see in crypto? So how do you think the views are aligned or perhaps not fully aligned between European Commission, the Parliament, and the governments? Do you see different like priorities or different concerns?
Yes, definitely. I do see different concerns or priorities. And this is, in my view, due to the fact that public officials, so officials of the European Commission, but also officials from the member states or members of the European Parliament, are very mandate driven or political group or political affiliation driven. So if you work in a department that is focused on financial stability, you're going to be concerned mainly about financial stability. If you're working in a department that is responsible for consumer protection or investor protection, you're going to be worried about that. If you are working on money laundering, your primary concern is money laundering, same with data protection. So it depends a bit on the perspective held by myself and by my colleagues is often very much influenced by where they're coming from or which is the mandate they're trying to fulfill. And the same we see in the European Parliament, really by political affiliation or sometimes by member state or sometimes both. So national perspectives on crypto assets can vary, with certain member states being more progressive on this, other member states being more conservative. And sometimes this is a national or cultural perspective. Sometimes it's a reflection of the current majority in their respective governments and whether they are more conservative or more progressive. So you see a multitude of approaches and positions, but I do think that they have evolved a great deal over the last, I would say, 5 or 6 years. So I really started focusing on crypto assets about 6 years ago. I sort of then saw the enormous increase in value in 2017. Towards the end of 2017, we had the first real big crypto peak. And at that time, while we at the European Commission saw, and certainly in the department I work in, the group I work in, we saw a lot of potential. And I've always tried to place myself in not one single perspective, but trying to balance between multiple policy objectives from stability and market integrity towards opportunity and efficiency and performance and privacy, placing yourself not at the extreme of any of these elements in the triangle, but trying to balance the various policy objectives, we saw there's a great deal of potential there. There's also risk, but I would say that the predominant attitude, both within the European Commission, but also among member states and in the European Parliament, was largely negative. People said, well, this is a bubble, it's going to end in tears, we should not legitimize this. If we do anything, it should be banned. And so that overall attitude also gave us, in our department, a bit of pause to say, well, this is not a great time to present a proposal that is trying to create legal certainty and try to enable and empower this this very potential technology and ecosystem. So we held back on it and worked really on trying to get people to evolve in their perspective, pointing out not only the risks, but also the opportunities and the advantages. And so I have seen a great deal of evolution since 2017 towards now, where at the time, officials that were pro crypto or not negative on crypto were few and far between. Now there's still quite a few government officials and members of parliament who are not at all fans of the crypto ecosystem and distributed ledger technology, but there's also a lot more people now who see the potential. And certainly there's enough people who see the potential that we were able to have a framework agreed that is primarily enabling and supporting of a safe development of this ecosystem. So we see this. Now, that said, in the European Parliament, there was a lot of talk. Actually, the most debated issue in the European Parliament were the environmental implications of proof of work consensus mechanisms, which was interesting because it's actually one of the issues that wasn't addressed in the European Commission's proposal at all. But there was a very spirited debate about it. And there was a significant body of opinion that felt that proof of work validation should be banned in the EU. How you're going to ban that is a bit unclear to me, but at least that was the political perspective on it. But it's also, and I'm often reminded of this very strong opinion that was held in the European Parliament. I said, well, that's true, there was that very strong body of opinion, but it wasn't the majority, because the majority in the parliament said no, we should not ban proof of work. Of course, we are concerned about the environmental impact of some of these technologies or validation protocols, but that doesn't. We do not think that banning them is the right way about it, and maybe having a disclosure regime, an information regime, is a better way about it. If you look at other parts, a lot of the financial services departments start off being worried about financial stability, or they started off thinking about financial stability concerns. But they quite quickly realized that for the time being, and this is also confirmed by the Financial Stability Board, there aren't really strong or very convincing financial stability arguments about crypto assets. And that's because the market is still relatively small if you compare it to other real financial or the traditional financial markets. And it's also still relatively, its degree of interconnectedness with the financial system is still relatively limited. And therefore the financial stability implications are also limited. But it's recognized that this could change quickly, and so we have to watch this. And so the main concern really among financial regulators is market integrity. Are the markets fair and operating properly? And here we do see a lot of reasons for concern, which have nothing to do with the crypto technology as such, but the way these markets, which fairly immature markets, operate, and the fact that there's a large degree of conflicts of interest, between the crypto asset service providers who operate trading venues, brokerages, advisory services all together, which is functions which typically in financial markets are separated. But in the crypto ecosystem, you see companies engaging in activities that present conflicts of interest. We see a fair degree of market manipulation or unexplainable market movements in crypto markets. And these are, I think, the areas that most concern policymakers and financial regulators, or that most concern them, and that we sought to address in the MiCA regulation.
Yeah, wow. There's a lot to unpack, from TFR to energy consumption and to many other things. Perhaps just to pick up on MiCA, what you just said, like the main concern is market integrity, fairness. And earlier you talked about we have the existing financial market regulation, but crypto assets do not always neatly fall into that. Probably they don't. So we come up with a new rule book, which is MiCA, which wants to create that market integrity, that fairness that you mentioned, and does that mainly through disclosure, mainly through that aim of, okay, we give more information, make sure we reduce information asymmetry, perhaps make sure there's enough information for people to be aware of what is going on, which team is behind a project, what kind of risk management approach they take, etc. And I was thinking about, when I look at traditional financial market regulation, you have, for example, this market abuse, conflicts of interest rules. And then in MiCA, we copy some of those same ideas, like we need a market abuse rule book for crypto, even though it's not financial market regulation. Was there any controversy, any discussion about what was the thinking about, okay, we have some rules for the financial markets and we put that in a rule book for crypto assets that are not financial securities, but mainly copying some financial markets traditional concepts into a non-financial context. So even though crypto assets are not financial instruments, we still need some financial regime like rule book when it comes to market abuse, etc. Was that an easy discussion to say, okay, we know these crypto assets are not considered financial instruments, but we're still going to copy paste some of the market abuse and other financial market rules? Was that an easy discussion to say we're going to transplant it from financial instruments to non-financial instruments? Or was it very obvious to everybody, we just need to expand market abuse, we need to cover crypto assets with this?
It was more of the latter, indeed. And so in the European Commission's proposal, we copied some of the elements, and some people call MiCA a MiFID light. And there's some truth to that. So we copied some provisions of MiFID, or we inspired MiCA on provisions from MiFID, but we didn't take them all. And so if I look back at the debate in the council, mostly it was member states saying, well, you've copied provisions X, Y, and Z, but what about A, B, and C? We also want to have A, B, and C from MiFID into MiCA. And so the debate was a bit, well, is this proper or not? So there was very little debate about those rules that the Commission had inspired on MiFID. So that was almost immediately accepted. But there was more debate about those provisions that the Commission had omitted or left, said, well, we don't think this should be in MiCA. And so if you compare what was agreed to what was proposed, you'll see that there is additional elements from MiFID also now in MiCA. And this is largely due to member states wanting to do this as a condition for them being able to support this. So they thought that maybe the Commission was a bit too light touch when it came to MiCA, and therefore they wanted to have these provisions at all. But I think it's also appropriate to inspire the rules on the rules for financial instruments, because although legally speaking, crypto assets are not financial instruments, from an economic and functional point of view, they have a lot of features. They behave very similarly. Not necessarily similar to equities or to debt instruments, but they do behave very similarly in the market to, for example, commodities in commodity markets. And so from that point of view, and I'm not saying here that they are commodities, that's a legal debate. I'm just saying that if you observe them, their economic and functional behavior is very similar to, and they have a lot of features too. A lot of people who buy crypto assets say they're investing in crypto assets now. Whether they're investing or speculating, that sort of depends on the eye of the beholder, I guess. But you see that if people are speculating or if they're investing, they need to have market integrity, they need to have investor protection rules, and there's not so many different ways of going about that. Investor protection rules often are about information, addressing information symmetries, and addressing conflicts of interest, or prohibiting the combination of certain activities within one and the same entity. That really is what financial regulation is all about.
And it would have been very surprising to hear a regulator or a lawmaker say, we don't care too much about front running or market abuse in crypto just because it's crypto. That would have been a very surprising reaction. Just perhaps going back to the origins of MiCA, much of it was at the time about Facebook at the time announcing they would have their Libra token. And there's still a lot of focus on stable coins. And we have two types of stable coins, the e-money tokens and the asset reference tokens. MiCA now also makes it clear and explicit that algorithmic stable coins are covered. Just a brief discussion we had before we started recording, my question, for example, on looking at DAI was at the time and still is DAI, the MakerDAO's token, is that an EMT or an ART? Because it references a single currency, the dollar, but it's backed by multiple assets. So I know this is not commission legal advice, obviously, and you cannot give any legal advice. These kind of questions, do you know, are we clear enough about these things? Do we expect more guidance on that? Do you have a personal interpretation, or have you seen anything in the negotiations that can help the lawyers out there trying to interpret the rules about how we could think about that distinction for a token like DAI or any other token?
Well, MiCA does cover algorithmic stablecoins, but in a way which basically prohibits algorithmic stablecoins. And let me explain this. If you reference a single currency, so if you pretend to be stable against the currency, you must be fully collateralized in that currency. So your algorithmic stabilization mechanism serves no purpose, because if you say my coin is going to be stable against the pound or against the dollar, against the euro, you must hold euro, highly liquid, highly secure, cash-like instruments in euro in reserve. So the consequence, so if you don't have that reserve, you're actually not an electronic money token, and you then fall into what we call Title II, general crypto assets. But if you're a general crypto asset, you are prohibited from making any assertions and statements as to the future value of your token, including a stable value. So either you say, well, this token is going to be stable against the euro, for example, in which case you must hold euro in reserve, fully collateralized,
100%,
or 100%, and then you're not an algorithmic coin, you're just a fully collateralized coin. Or you say, well, I'm an algorithmic coin, and that's fine, you can be an algorithmic coin, but then you cannot make a stability claim. And so the answer to the question, is DAI, what is DAI, is that currently, and this is not legal advice, this is just my own personal
your own opinion, just to be clear,
is that DAI would currently not comply with a MiCA, because, and so once MiCA enters into force, if DAI wants to remain on the European market, they will either have to fully collateralize, or they will have to drop, and then they'll become an e-money token, in which case they would have to also get approval, authorization. They would have to do white paper, need to be authorized and everything, need to meet the prudential standards for e-money tokens. Or they say, well, we don't want to do that, but then they will have to drop their stability claim.
Okay, so in that case, dropping the stability claim is enough for DAI to continue surviving legally beyond 2023.
Yes, but they cannot purport to be stable then anymore. Now, that's going to be a problem because, of course, they market themselves as being denominated in stable in, well, they're not denominated, they're pegged to the dollar.
Yeah.
So that they say, and we have this system to stabilize that. But the reason why we implicitly or indirectly ban this is not because we want to be difficult or we've got something against DAI or anyone else or MakerDAO and so on. But both our expectation before, but also this has now been demonstrated by the fact is that algorithmic stablecoins are a very, very interesting math experiment. They're very interesting, but they're not stable. They are a contradictio in terminus. So now people say, oh, but look, they've been very stable over the last X months and so on. And yes, if we look at that performance over time, you see that they tend to remain pretty close to their peg. They oscillate a little bit around their peg in a very small boundary. But as soon as there is stress in the system, this bandwidth in which they start to fluctuate becomes much bigger. And stability for a stablecoin is not demonstrated in good times, but it's demonstrated in times of stress and duress. And so far, we see that the only viable stability mechanism, and it's not, and even that's not perfect, is full collateralization. We see over the stress incidents in the past is that those coins that were able to keep their peg were the ones that had a audited, incredible, fully collateralized system. So when you saw, for example, when Terra Luna went down, of course, they also had their stability claim, but they were not collateralized, and that sort of was a problem. We saw that, for example, US dollar coin remained stable. There was a fair amount of redemption in US dollar coin, so its market capitalization went down, but its value remained, it didn't lose its peg. But for example, US dollar Tether did lose its peg. It regained its peg, but it would appear, although it is very hard to demonstrate, but it would appear that the reason why it lost its peg is that there is still market doubts as to whether or not US dollar Tether is fully collateralized and what the quality of that collateral is. So we believe in the European Commission, and this is not my personal opinion, but it's generally a position, but this is also reflected in the MiCA regulation as agreed, is that to have a stability claim, a credible stability claim that users and consumers can rely on, you must be fully collateralized in the asset against which you claim that stability. So if you say, I'm stable against the dollar, you must hold dollar. If you say, I am stable against gold and silver, you must hold gold and silver.
And the Terra meltdown that you just referred to probably didn't help this discussion about what to do with algorithmic stablecoins under MiCA. I can imagine that had an important impact on the discussions.
Yeah. It basically confirmed, although that issue had by then mostly been settled, but it confirmed the idea of, some people would call it prejudice, which we had, that that algorithmic stablecoins don't exist. Well, they exist, but they're not stable, and therefore they shouldn't be called stablecoins.
And then immediately when we think about how do we regulate stablecoins, well, algorithmic stablecoins, and when we talk about DAI, my first question is, well, if these rules are there, how are we going to enforce that? If you have a MakerDAO, and then you have the DAI token, which is going through Uniswaps, going through all these DEXs, going through various transferring protocols, how can we enforce a rule that says basically DAI either has to be fully collateralized or it cannot market itself as stable? How do we enforce those rules? And I had the same question when I read, when we had, there you have this provision in MiCA that caps the issuance of certain types of stable coins to a certain average daily amount or a certain total volume. And there again, depending on what kind of token we're talking about, what kind of issue we're talking about, I was wondering, have there been any negotiations about, or any parts of negotiation that can shed light about how will we enforce this when some of these tokens do not have a clear centralized intermediary behind them against which you can enforce these rules?
Well, that is a very, very good question, a very good point, is that MiCA is also, of course, a political compromise between different perspectives.
Mm.
The European Commission wanted to provide a legal framework that offered legal certainty, that offered market integrity, investor protection, consumer protection, and we got a long way in that. But then other perspectives also came in, like, for example, the issuance cap, which you mentioned for non-European currencies denominated stablecoins, really is a reflection of the aspiration of some member states on what they call monetary sovereignty, or the fear that if we don't have such a cap, that foreign currency denominated stablecoins would start becoming a dominant feature in the EU market, and therefore they placed this cap in MiCA. Now, how you enforce that cap is going to be a
Different
difficult
question.
question.
Yeah.
We'll have to see in how the market operators will operate in practice, because of course the rules are clear that you cannot issue these things in the EU. So if you are, and MiCA says, if you issue in the EU, you must be established in the EU, you must be authorized. But what if someone doesn't do that? Can we do not have in the EU, we do not have a tradition of extraterritorial application and enforcement of our rules. So if someone places these tokens on the market in another part of the world, we don't have an armada to send them and sort of go and capture them and bring them to justice. So we'll have to see how that works. And now some people say, well, if they're issued in the US, they'll stay in the US. But I say, personally, I think that is doubtful, because the place of issuance of these tokens doesn't matter. It's often hard to determine. And even if you
Exactly.
can determine that they were issued in a particular jurisdiction, because they exist on a blockchain, it takes just one transaction for them to end up in the EU. Now, whether they will stay in the EU or they'll go from the EU somewhere else, who knows? So this is indeed hard to enforce, even if there is an identifiable intermediary that does not subject itself to EU rules. But it becomes extra hard to enforce if there's no intermediary at all, if it's just protocol based or smart contract based. And this is where MiCA has a limitation, also by its design. Regulation, all regulation, not just MiCA, but all regulation I'm familiar with, always is a reflection of the market reality and the state of the art of technology at the moment regulation is drafted and negotiated, especially when it's drafted, when it's conceptualized. And MiCA was really conceptualized and developed in 2019. At that time, stablecoins were just emerging, but it was really the Libra-like stablecoin. So that's why this ART, this asset reference token with baskets and so on, is so prominent in MiCA. So, for example, all of this talk about both decentralized finance and even non-fungible tokens, it wasn't really a big issue. I know it's just 3 years ago, but at the time, no one really mentioned it. So it was just emerging. But we said, well, we don't really think we have to address this. And more importantly, we can't address it in MiCA, because MiCA, like all regulation, addresses intermediaries. It's administered through intermediaries, either the issuers or the offerers or the crypto asset service providers. So if there is an issuer or if there is a crypto asset service provider, that it becomes a locus point for your regulation. You apply that. But what do you do if there isn't? And so now a lot of things are called DeFi, people, because it's a very en vogue term. But if you look more carefully at a lot of things which are called DeFi, they really are dinos, decentralized in name only. So there is actually an intermediary. And we say, well, look, it doesn't really matter to us what you call yourself. We just look at the facts. If there is an intermediary behind it, either as an issuer or an offerer, that person falls under MiCA if they do that activity in the EU. If there's an intermediary that offers crypto asset services as defined by MiCA, they will have to have a crypto asset services license. But if these entities do not exist, then they fall outside. And I'll give you an example of actually some longer standing and quite significant DeFi, and which is the Bitcoin blockchain itself. Bitcoin is not issued. Therefore, the issuance requirements of MiCA do not apply to Bitcoin, because Bitcoin emerges on the market as a result of mining reward. And MiCA is quite specific that mining reward is not issuance. So the Bitcoin issuance is not regulated by MiCA because there is no issuer. But so in a way, Bitcoin is decentralized finance. But the provision of services to Bitcoin, wallet services, brokerage services, centralized exchange services, advisory services, what have you, by intermediaries is covered. And so the question is there an activity either in the issuance or the offering stage or in the services stage where there is no service provider or there is no issuer? If there is no service provider, then that's not covered by MiCA. And take, for example, then the question is that, well, if someone drafts a smart contract or an application, an app that allows you to engage with a smart contract or with a protocol, is that a crypto asset service? Under MiCA, it isn't. And so
it isn't.
It isn't. And so now there is debate about this. And people say, well, although we still have to formally adopt MiCA, we already hear voices about the MiCA 2, and you have to do this and you have to do that. But the Council and the Parliament did mandate and did ask the Commission to come forward with a report to address these issues, which are not explicitly covered or which are partly excluded, for example, on decentralized finance. And we will be doing that. So we will see, well, is there a big problem of market stability, market integrity, investor protection in DeFi? Or is there a problem that in the absence of a regulatory framework, this activity can't develop or can't be successful? That can also be a problem. So first you have to establish, is there a problem? Then you have to say, well, is regulation a solution to that problem?
Yeah.
Which may or may not be the case.
Yeah.
But let's say that regulation is a solution to but let's say there is a problem, and let's say that regulation is a solution to that problem. Then you still have to determine, well, what are we going to write into that regulation? And when it comes to true DeFi, so non-intermediated decentralized finance, we will then require a real paradigm shift, because we will have to come up with a way to regulate that does not go via intermediaries, because there are no intermediaries. And up until now, I have not yet heard a great idea of how to do this. If you have one, if any one of the listeners have a great idea of how to do this,
they can come your way.
Come and see us, send me an email, whatever, as to say, well, this is the way to do this. I must warn your listeners already that I've heard already quite a few bad ideas. So it's not that I haven't heard any ideas how to do this. Well, I'm not going to sort of embarrass anyone, but we hear people, oh, you should hold the people who draft the code liable. You should hold the people who host the servers liable. So any idea is out there. And then there are also people saying DeFi should not be regulated at all. It should be left to complete freedom. And so we don't know yet. We're going to look at that, but we first must establish that there is a problem, and also of that we are not yet convinced, because while decentralized finance does exist, it does seem to be fairly limited. That often many things that hold themselves out as being decentralized aren't really decentralized. They are centralized entities, intermediaries that use decentralizing technologies, but you can still find someone who is actually behind the system. And even we saw that with Terra Luna when went down, that was allegedly decentralized. But then we saw when it was going in trouble that people who were behind the protocol tried to rescue it, tried to move money into it, and so on. So there were obviously people who were having control over this. Now, this may also lead to a debate as to whether DAOs are intermediaries or when or under what conditions. I don't have the answer to this, but it's a very active debate as to maybe, I don't know, maybe we'll come to a new definition or a new paradigm on what is a service provision or what is an entity, and can you have a non-incorporated entity, something like a DAO. And if you put DAOs with a few people which have governance rights, and maybe that's closer to an entity, but then you have DAOs with hundreds, thousands of people, and then it becomes very hard to say, well, that's really an entity. That's more like a movement. So I think this is going to be a very interesting, often a bit of a philosophical discussion, and we'll need to see how the market evolves. Maybe the issue just disappears altogether, in which case we will not have to address it. But if it takes on and it sort of takes a life of its own, and it presents problems, then we will have to come back to this, and hopefully at that time we are much wiser, or we have good ideas as to how to address this.
Yeah, and I think you make a very good point that I think it's very important what you said, that DeFi is excluded. And there's what you just said, it shows how many open questions there are. And with those open questions, perhaps it's very risky to try to draft a law that would apply to DeFi without even knowing fully what is DeFi or what is a DAO, what do we consider to be fully decentralized or not. In the meantime, but by the time MiCA enters into force, which depending on whether you're service provider or issuer, maybe 2023 or a little bit later. In the meantime, of course, if you're in the crypto asset world, you have to know, am I an issuer? And what I anticipate is that there's a lot of, as you say, dinos in decentralized finance, decentralized in name only, and there will be many centralized entities that just see themselves as centralized entities, companies that provide some kind of service that would definitely fall under MiCA. But then they also engage with DeFi. And since DeFi is outside of MiCA for now, but since these service providers are inside of MiCA, covered by MiCA, perhaps there may be some questions, for example, if you're a crypto exchange that is centralized, it is an entity, maybe in the EU, maybe outside the EU, and you may have customers in the EU, but you allow your customers to engage with, again, say, DAI, to come back to our example. And DAI is DeFi, therefore is DAI perhaps outside of MiCA, but the service provider isn't. And then thinking about how would the service provider have to deal with DAI, say if DAI would not comply with MiCA when it comes to 2023. And I can imagine in the meantime, until we decide what DeFi is and what we do with that those service providers who are clearly centralized and are subject to MiCA, but still engaging in some way with truly with DeFi protocols or with DeFi tokens, that they may have some questions about how far are we expected not just to comply with MiCA as ourselves as entities, but also for the tokens that we allow our users to trade. If those tokens somehow are not covered by MiCA, but or perhaps they are, do we say we stop trading DAI, or we stop allowing our users to use DAI when DAI would reach a certain issuance cap? Do we just say, well, DAI is no longer following MiCA rules, or do we say, well, DAI is just outside of MiCA, we can just allow our users to engage with MiCA with DAI transactions for as long as DeFi is not under MiCA? I can see there's, because the centralized crypto world covered by MiCA and the truly decentralized DeFi world not covered by MiCA, because those two will interact, that there may be some questions until we have clarity about what DeFi actually means and when it is outside of MiCA, when it is inside of MiCA, and what rules may apply, if any, to DeFi. I can imagine the interaction between the two may raise some interesting questions, both for policymakers, but also for the companies who have to make sure that they still comply a year from now, 2 years from now, even when we don't have clarity yet about what is DeFi and what do we do with that.
Yeah, I think that's going to be mainly a problem for the companies, or a commercial decision as to companies they have to comply. If they fall under MiCA, they'll have to comply with MiCA. And the requirements, for example, on crypto asset service providers are explicitly stated in MiCA. And it doesn't really say that you are prohibited from providing services towards an issuer that does not respect the issuer cap, for example. So you do not invoke your liability under MiCA because the issuance cap applies to the issuer.
Yeah.
And if the issuer doesn't respect that obligation, or we can't enforce the obligation, that does not imply that the crypto asset service provider all of a sudden becomes liable for that. But I hear these questions regularly, but MiCA doesn't really invoke that. Of course, we'll have to see how the member state national authorities will enforce that and will apply MiCA, because when it comes to issuance, significant issuers will be supervised directly by the European supervisory authorities and by the European Banking Authority. But the crypto asset service providers are going to be supervised, they're going to be licensed and supervised by national authorities. And while we will have delegated acts to specify some of the details, and there will be coordination within the European supervisory authorities to coordinate not transposition because of regulation, but to coordinate enforcement, you will still see, if I look back in the past in other regulations, you still see variations in enforcement or difference of emphasis or differences of interpretation. Now, when such differences emerge, normally the regulators are supposed to bring this to the European level and sort of attention for discussion, and then we'll see how we solve that. So it may well be that these issues of how do we deal with MiCA service providers providing or facilitating interaction with non-regulated activity or with non-compliant activity, even how do we deal with that? We will have to see that at that stage. I believe in solving problems when they present themselves, and not in inventing solutions for problems that haven't emerged yet. Because whether or not it will be a problem, we need to see it. We provided a fair, I think, quite a considerable degree of legal certainty and a framework which is very functional, but we haven't answered all the questions. But compared to, for example, other jurisdictions in the world, we've provided an awful lot more clarity than others have. And one of the elements of clarity which we did provide, for example, is that up until now, we saw that traditional financial entities were very reluctant to engage with crypto activity because it was unregulated. And banks and financial institutions are full of legal and compliance departments who don't like this kind of stuff. Now they can interact with the crypto ecosystem. Now, I know that a number of people who are very active in the crypto ecosystem would find that blasphemy. The fact that banks would get involved into crypto would be really everything that Satoshi Nakamoto didn't want. But we think that this technology has enormous potential, both for innovation and non-bank, non-traditional finance intermediated financial-like activity. But we think it also holds enormous potential for the traditional financial industry. And I, for one, think it is welcome that the traditional financial industry were to engage and were to provide services also in the crypto space. And for that, they needed a legal framework. So what we did, well, we haven't clarified, nor that we made it illegal for crypto asset service providers to interact with the non-regulated space. We have provided a lot of clarity for traditional financial operators to engage with the crypto space, at least the regulated crypto space under MiCA. And I think that's a great achievement.
Yeah, regardless probably of what people think banks should be engaging with crypto or not, it's happening. It's happening in any case, whether the
It's
listeners.
happening, and while I have my own perspectives and kind of even my hopes for this, ultimately we want this to be a business decision. We're not saying to banks, you must do this. That really, it should be a decision for a commercial decision for the bank or the financial service provider as to whether they want that or not. And if there's a banker who says all of this crypto stuff is all very dangerous, it's going to end in tears, it's a scam, that's fine. We're not obliging anyone to engage in this activity. But if someone says, well, I see great potential in this, I want to provide my customers with services into the crypto space, we believe that that should be possible. And we've created a framework for that so that market integrity and investor protection are assured.
And I think how you just so clearly explained what MiCA does and what MiCA doesn't do. I think the crypto companies and perhaps others listening will be very reassured by what you said. I think your approach is a very pragmatic one. As you say, well, we have this framework. It doesn't say explicitly you can't do certain things. It doesn't necessarily say this is inside. This framework that we have, it offers legal certainty and it can be applied very rigidly, which may not work very well, or it can be applied pragmatically. And I think the examples you just gave and the clarification you just gave about, say, DAIs, about stablecoins, about algorithmic stablecoins, I think is a very pragmatic way of looking at this space and saying, well, it's not because MiCA touches on certain things that we should perhaps exaggerate how this will be enforced or be interpreted. And that perhaps we also have to be very clear, like the examples you just gave about the liability of an issuer versus the liability of a service provider. I think that's very reassuring for many crypto companies who may be listening to understand, okay, we don't need to, perhaps our understanding of MiCA, we shouldn't exaggerate the impact it may have on, it's not a disproportionate impact. It may very well be a very pragmatic application, very pragmatic interpretation. So I think it's really, really great to have somebody like you who knows it inside out, who's seen all the concerns, and those concerns will probably translate into how it's enforced and interpreted. Even though there may be small variations, those can be resolved as well at the European level. So I think it's really, really reassuring to hear how you interpret MiCA, what you think it does, and what it doesn't do, but it's not disproportionate to its aims and the concerns that you just described so well about market integrity, fairness, etc. I know we're running way over time. I had two more small questions about TFR and energy, but I don't want to take up any more of your time. So I just want to say thank you so much for explaining MiCA and all. It's such a long document. There's been so much heated debate about many of these provisions. Thank you so much for explaining it so clearly and clarifying to many of us who are still in doubt about some of these provisions how we should be looking at this. So thank you so much for making time to clarify that for us.
It was my pleasure.
Thank you, Peter.
Thank you.
Thank you.
Bye.
Bye.